There's a very good chance that my my 3-year-old will interrupt this weekend podcast for you. So if that happens, just go with the flow. I pick her up on Friday afternoons at her preschool, and right now I have her connected to a video, so that should be pretty good. Um, it's really interesting looking at price charts, and I had a good question come up this week that I want to share with you, and I think it will shed light on kind of why things work the way they work in regards to price charts, and why I'm such an advocate of technical investing and looking at price charts and keeping things simple. So I want to share that with you. Now, the theme, I guess there's kind of maybe be two themes this weekend, and they'll both come out, though I only have one on the screen, on the next screen, so I'll share that with you, and then I'll talk about the two in this podcast. Hey everybody, this is RC Peck, and this is my weekend podcast, and the theme for this weekend is prices move in specific patterns to strengthen their trend. So one of the questions I've often gotten is, well, why does a stock correct 38% from its last major move, or 50% or 61.2%? Like, why does it make those corrections? Why is certain moving averages seem to pull the price to them and then push it off? And the thing is, price charts, like everything in nature, is always moving towards strength. Right? So you look at a shell, the reason the shell is the shape that it is because over the last 100 million years, billion years, however long shells have been on this planet, the planet itself is 5 billion years old, shells have figured out that the ones that can create a specific shape are stronger and they last longer. So shells have had a certain specific shape. The same thing goes with pine cones and other natural structures on this planet. The Mother Nature has figured out what are the strongest shapes to strengthen the life of that specific species or plant or whatever living thing it is. And it's the same thing with price charts. Price charts move in a way to strengthen their trend until that trend breaks. And it's this strengthening process, this patterning process, that gives us very huge clues and insights into where the opportunities are. The first price chart I want to bring up is the S&P 500. It is moving right back to its old resistance in September of this year. It could not get above that 2,000. It was trying to get above that 2,000. It finally broke back down to about 1,820 briefly, and then moved right up through that 2,000, really right past it, almost to 2,100. And now it's coming back and sitting right on top of that 2,000 mark. This is strong. This is what we want to see. You want to see a price chart break through old resistance and then have it become support. Now, we don't know yet if the 2,000 is going to be support. The market kind of sat on it today, so we'll see in the coming days and weeks, but that is a typical strengthening position. And there's other ones on here, but I just wanted to show you that one, how prices really move in a way to strengthen their trend. The red line on the screen is the 200-day moving average, just to give you a general idea of which direction the U.S. stock market is going. And you can clearly see it's going up, and it's going to continue going up until really otherwise, but there's not a lot of competition to the S&P 500 right now, and that's where a lot of money is flowing. I wanted to bring up oil too. Now, oil is very interesting because it affects a lot of us. Well, it actually affects all of us because energy is a huge input into a lot of companies. And I showed you this price chart last week, but this time I zoomed in a little bit more, and this just goes back to 2009, and it shows you that upper trending line, which is it's just a little bit below where oil closed today. West Texas Intermediate Crude, WTIC, closed at about $59 a barrel, and it's going to want to get to that. Now the question is, what does it do when it gets to that trend line? Does it crash through it? Does it take a break and go sideways for a week or two and then continue down? We don't know. So I'm going to be watching for breakouts to the upside and to the downside. My gut, and what the Saudis have been doing the last month, or maybe a little bit more the last 2 months, is I think they want to take oil down to $35 a barrel, somewhere between $35 and $40 a barrel, which is what the low was in 2009. And so it would not be unreasonable to see oil at $35 a barrel, $40 a barrel in 2015. That's going to wreak havoc on a lot of things. It's already wreaking havoc on the junk bond market because about, generally speaking, 20% of junk bonds are connected to energy exploration, production, businesses. So it's connected to energy. And as we see energy stocks falling pretty hard, we're seeing the junk bond market fall right with it. This is an ETF JNK. The red dot on the screen is where the price started this year at about, $40.50, and now it's at $38 plus or minus. So from a percentage point of view, not that big a fall, but as you can see visually, we're down to the 2012 lows, looking like we're going to go to the 2011 lows. So if oil does continue to fall, the junk bond market, people are going to be taking their money out of the junk bond market. Everything is connected. And that was the second theme of this weekend podcast, is that everything is connected. When oil moves down, it affects junk bonds, which when junk bonds move down, it affects the long U.S. bond, literally the 30-year, the 20-year, the 10-year bond in the U.S. Now this is a price chart of the bond. So as this price goes higher, people are literally willing to pay more and more for a 20 and 30-year U.S. bond. Now they're getting less and less in yield, but they're looking around the world saying oil's going down, junk bonds are falling, I'm scared of the stock market, Europe's a mess, Japan's a mess, I don't know what China's all about. But you know what? Up to this point, the U.S. has been the most stable country on the planet the last 200 years. Yeah, it actually has. And you know what? I'm just going to put my money with the U.S. government for right now. If you look at the screen, you can see the long bond price is getting to 2012 highs. It's going to hit it. This is amazing. It's actually going to hit that price, which is driving the yield down on the 30-year bond. That's connected to also the 10-year bond. Look at the yield on the 10-year bond. I wanted to show the 10-year because I wanted to show the yield on the 10-year bond because I wanted to get as many different kind of impacts and how everything is connected. This is the yield of the 10-year Treasury. The red dot is where it started at the beginning of the year. Call it 2.8% yield, 2.9% yield. Actually, maybe that was right around 3%. It bounced off it. But go back to 2006, which is at the beginning of this chart. The 10-year Treasury was yielding 5%. It has easily been cut in half from that. That has lowered mortgage rates in this country. Now, other mortgage rates around the world are probably also being lowered because yields around the world are coming down as people are getting concerned. But what's so interesting is I think we're going to see the 10-year Treasury at 1.3% yield again, which is what it was in 2012. And that means you got to get ready to refinance your house or your investment properties. We could see that in 2015 where yields are low enough, and you absolutely need to call up your broker, mortgage broker, banker, and even for investment properties, refinancing them, people can lower their yields 2-3 percentage points. This is how everything is interconnected. It's so amazing what's going on. I just love it. It's so fascinating to me. But even with this price chart, you can see that 200-week moving average on this price chart. The red line is the 200-week moving average. You can see how it bottomed at the end of 2013, but the price or the yield is actually going against that right now. So what's the takeaway? Everything is connected, and price charts, prices move in a very specific pattern to strengthen their trend, to strengthen their direction, just like things in nature do too. And those kind of correction patterns are very measured, and there's a predictableness to them. There's a probability to what they will be, and that's where you can actually find your edge. That and how you behave around investing in those. But everything is connecting. So when oil falls, and it is absolutely falling right now, that means junk bond prices are going to fall too, because junk bond prices are connected to oil. And when junk bond prices fall, you got U.S. long-term bond yields falling too. It means people are moving into that. And when those fall, that means you got to refinance your house. It's all connected. Everything is connected. So get the paperwork out. Call your mortgage broker. It's going to be time to refinance your house again. This may be one of the last times in the next, who knows how long. I shouldn't say that. But it looks like, we're going to have another opportunity to refinance our houses and even buy more investment properties. Lots of great things that I'm excited about in 2015 that I'll be sharing with you over the next few weeks. But definitely one of them is the real estate course that I started teaching over a decade ago, and I want to bring that back out. It is as relevant as it's ever been, so anyone who wants to buy an investment property, that's going to be the course that you're going to want to be part of. Hey everybody, this is just another step in securing your portfolio and your future. Until next time, this is RC Peck.